guys, welcome back to X and Yon channel. Have you ever wondered whether the tech stocks are overvalued? The FAAMG, Facebook, Amazon, Apple, Microsoft and Google are the top 5 tech stocks in the S&P 500 by their index weighting. The index weighting for Facebook is 2.1%, Amazon 4%, Apple 5.3%, Microsoft 5.5% and Google 1.7%, account for a total of 18.6% in the S&P 500 index. These are the closing price on 26th of June 2020. Facebook price at 216, Amazon 2,692, Apple 353, Microsoft 196 and Google $1,359. In the 5-year time frame, these 5 popular tech stocks are at their peak, although in the midst of coronavirus outbreak. For Facebook, its price was as low as $146 in March. It was almost a 60% surge. Most investors use PE ratio, price to earning ratio, as a consideration to buy the stock or not. In my previous video, I shared about how to check a stock profitability by looking into their EPS, earning per share. To get PE ratio, divide the EPS by the market price. You can find the market price using the stock app in the iPhone or check it out at Finance Yahoo website. To save time, I have computed the PE ratio for the 5 tech stocks. I'm using the market price as on 26th of June. Remember, the higher the EPS, the higher the profitability of the stock to the investor. More often, investors want to buy quality stock at the cheapest possible price. Hence, they are looking to buy at lower PE ratio. The lower the PE ratio, the cheaper the stocks to the investor. Apple has the EPS of $12.73 and its price is $353.63. The market price divided by the EPS, the PE ratio for Apple is 27.78. What does that mean? Meaning, investors are willing to pay $27.78 for each dollar that Apple earns. In comparison among the 5 stocks, Amazon has the highest PE ratio of 128. Meaning investors are willing to pay $128 for each dollar that Amazon makes. Why are investors willing to pay so much more to buy Amazon stocks? This is because investors believe that Amazon has the growth potential to earn more than that. Now, ask yourself, how much more are you willing to pay for the $1 that Amazon earned you last year? 20 times, 30 times, or 50 times more? Again, you need to do your own research on the company fundamental, whether the stock has the growth potential in the future. In the 3 months time frame, these tech stocks have proven to us that they are COVID-proof. However, please do not depend solely on PE ratio to buy the stock. This can be very subjective. As an investor, you need to make comparison to the industry average. In the CSI market website, it is stated that the PE ratio for tech sector is at 35.11 in the second quarter of 2020. If we use this as a benchmark, Amazon stock seems to be overvalued at the market price of $2,692, while the other stocks seems to be at or lower than the industry average in the technology sector. If we use a tech average PE in the macrotrends.net, the PE ratio is only 14.22 as in June 2020. In comparison, all the 5 tech stocks in FAAMG are overvalued. However, do consider the variation of business models of each company. In Finance Yahoo, we can check out the stocks in particular industry. For example, in technology sector, Apple and Microsoft have the highest market capitalization. In comparison, the range of PE ratio is between 9 to 419. I personally has a bias to use Apple iPhone because I think it is very user-friendly. It is not uncommon that a person can own multiple Apple products starting from iPhone, MacBook, iPad, or AirPod. This is because Apple itself has a very good ecosystem that draws its customer to buy more products that work simultaneously. Facebook and Google are in the communication services sector. In comparison, Zoom has a highest PE ratio of 1,519. It is seen to be too expensive. The lowest PE ratio is only 7.83, which is the China Mobile Limited. Amazon is the largest e-commerce platform in the world. It generates the largest revenue compared to other e-commerce companies. It is more closely to be categorized in consumer cyclical sector. In comparison, Amazon PE ratio is lower than JD.com, which is at 405, but Amazon is more expensive compared to Alibaba at 61.68 and eBay at only 8.8. A very good lesson was learned back in the internet bubble in late 1990s and early 2000s. Company that has .com in their name can see their share price surge rapidly and hit a very high PE ratio. Investors speculate the company to grow without considering the company earnings and cash flow. It is very important to check on the company fundamentals, whether they have positive earning and positive cash flow to sustain, especially during a pandemic like this. Do not blindly invest just because the stock looks too cheap to be true to you. In tech sector, stock regularly maintain a PE ratio between 30 to 40. Anything more than that, you need to do extra homework to check on the financial health of the company and its growth potential. That's all about it. Hope you guys can spot opportunity in the midst of crisis. If you haven't subscribed to our channel, do click the subscribe button and stay tuned for more content like this. Do smash the like button and comment below. It will help with the YouTube algorithm. Thank you very much for watching and see you again next week.